Good evening, all, and welcome to the session with Edelweiss Mutual Fund. I am Shikha Sood, part of the product team, and I'm joined by Niranjan Avasthi, Senior Vice President. Today's session is very interesting. We call it New Investing Style in Town. Factor investing is what we're referring to. But truth be told, factor investing has been there for more than a century now, with investors deploying factor-based strategies for making investment decisions. In fact, what we've seen globally, here we've taken a proxy of smart beta ETFs that you can see on your screen right now, which are about $1.5 trillion worth. So you can see the asset size is very significant globally. And even when you look at the number of products that are available, and in proportion to the market cap or broader base index, they are significantly high. So, of course, over the last few decades, they have made their mark globally, and they are part of significant proportions into investors' portfolios. What's interesting also is that specifically over the last 6 months, we've seen a significant growth in factor-based strategies in India as well. We can see in September 23 from 7,400 going up straight to about 14,300 in March 24. That is about 100% rise within 6 months versus a very humble start of 3,200 in March 2022 and 5,500 in March 23. So, Niranjan, I think it'll be a good time for us, for you to help us understand of why factor investing has picked up so much, and if you could delve into some of the basics of what is factor investing and why is it interesting and why are people moving in that direction.
Thanks, Shikha, and thanks everyone for joining in today. So let me start with very basic, what is factor investing? And, because we are into cricket season, the World Cup is going on, let me start with an analogy of cricket that is, most understood and most loved in India, especially. So if you see, while we are playing cricket in US today, the pitch is quite slow out there. And what you need on a slow pitch is you need bowlers, or rather spinners, who can turn the ball, who can make it difficult for batsmen to play, because they have a proven track record. Spin bowling works during slow pitch conditions. Similarly, on the batting side, you need players who are maybe defensive, reliable, experienced, along with being in form. Now, when we talk about different kinds of players, bowling, a spinner, maybe a seamer. If it's a bouncy pitch, you need bouncy bowling, and you need a seamer who can take more wickets, who can speed up the ball. So like, you have players with different kinds of playing ability. You create a team basis what the pitch is, what the playing conditions are. And similarly, when we talk about investing, each stock is characterized in some or the other basket. Let me take example of a growth stock, which has a very strong and consistent sales profit. It usually does well when economy is doing well, right? Economy is growing very fast, GDP growth, like in India is growing at 8% per annum rate, and growth stocks which are growing very fast tends to do well. Similarly, in a market like maybe a COVID, when economy was struggling, you will need stocks that are defensive, which are low volatile. Now, in every condition, these kind of stocks do well. And what is factor investing is nothing but labeling these stocks, their characteristics, and then creating a portfolio of these specific characteristic, or stocks with these specific characteristic, expecting them to perform in a certain market condition, whether it is in a long term or maybe in the short term. So factor investing is actually, involving, or rather involves selecting these stocks based on their characteristics that are factors, which is growth, momentum, quality, and etc. And there is a belief that they would contribute to the overall stock performance or the portfolio performance during different market conditions. So that's broadly, factor investing is all about. But what is more important is to understand how these factors differentiate each and every stock. So let's delve more deeper into what are these factors that we are talking about. And these factors are not, limited to factor investing. When you create a portfolio in maybe a normal fundamental style of investing, what we call, you definitely look at these factors. Now, only difference in factor investing is you rely more and your decisions are based only on these factors. There are no other biases that comes into decision making. Now let's understand the world of factors. Typically, size is a very basic or a simple factor that defines returns of a stock. You would have heard that in the long run, small caps or small cap companies tend to do better than large cap companies. That is size factor in play. So if you want to use that factor, what you would do is in your portfolio, you will bunch up small cap stocks with the expectation that small caps would outperform the other large cap or maybe mid cap stocks in the long run. That is size factor. The other important factor is quality. Now, in tough market conditions, when not every business is growing, there are a bunch of few stocks that have sound balance sheet, that have very high return on equity, return on capital employed, and very low debt to equity. Now, during tough market conditions, or where markets are not going full hog, not every stock is growing, quality stock tends to do well, and they are all quality because their returns ratio are very good, low debt to equity. Some examples, like if you talk about Maruti, a very a blue chip company with more than 40-50% market share in passenger vehicles, have seen many cycles in India, have gone through many tough conditions in the economy, have still done well. And currently, if you see most of their return ratios, its return ratios are good. So that's quality stock for you. Then there is growth. We talked about, growth stock, where their growth is typically, when you talk about growth, is their sales growth, revenue growth, profitability growth. Each of these metrics are growing very fast. And when I say growing fast, is on a relative basis. So if there are a bunch of maybe 10 companies in a sector and 2 companies are shining more than the others in terms of growth, these are tend to be growth stocks within those sectors. Now, a few examples at this point in time, like ICICI Bank within private banks over the last 5 years, we have seen has been growing much faster than its peers. Bajaj Finance for last many years, couple of years, have been growing very fast compared to many other NBFC. Titan, for instance. So while these are not recommendation, let me give you that disclaimer. These are just examples and for illustration to understand what are the characteristics of these stocks. Now, very important other style of investing. A lot of people, call it the Warren Buffett style of investing. That is value. Now, what is value? So value is basically a bunch of stocks that are trading at lower valuation. When we talk about lower valuation, it could be based on price to earning, price to book, maybe dividend yield. Most of these stocks are actually trading at dirt cheap valuation compared to their counterparts or maybe some other sectors. And these are value stock. Example, couple of years back, SBI was trading at a steep discount compared to many private banks. Even today, if you look at the price to book value of SBI is quite low compared to private bank peers. Of course, it is for the reason, but these kind of stocks are called maybe value stocks. And there is a cycle when again growth is not very good, and people tend to look at stocks that are trading much cheaper but are still growing, and that's where value tends to do well. In India, after almost many years, we've seen last 1 or 2 years, value stocks have done quite well. Then there is low volatility, which means stocks that are that have low volatility in their stock prices. Volatility actually helps in reducing the overall risk of your portfolio. So low volatility is one of the factors that is being used very significantly and prominently in factor-based investing. And last but not the least, and one of the favorites of Indian investors in recent time is momentum investing, and we'll see more about this today. But broadly, momentum investing is investing in winners, stocks that are doing well in the recent past. The expectation is that they will continue to do well, and momentum investing is all about riding over these trends or these stocks and investing in them. So this is broadly, the universe of factor investing at a very, basic level, which, characterizes stocks into different, compartments, and investors can pick and choose these factors and create portfolio based on their objective of, what they want from their portfolios. And yes, very important what Shikha mentioned. So while we have, the title of this webinar is New Investing Style in the Town, the fact is it is not new investing style. Factor investing has been researched, in fact, has been the most researched way of investing. In 1960s, it all started when, I don't want to make it sound too complex, but a simple market-based index or market cap-weighted based index, that is market beta, was invented. Many indices came into the world using market beta as a simple concept. Then low volatility is one factor that got added, was researched in 1970s, and over the next 2 decades, value, then size, then momentum, these factors were researched and, published, and people started using it in their investing style. And recently, in say around 2000, quality and growth were introduced. And now, as we speak, over the last 10 years, we have not only stayed to single investing or single factor investing, but now there is a huge, usage of multi-factor investing, where we tend to, or a lot of investment strategies tend to mix up different factors to create portfolios that can do well across multiple cycles of the market. So that's a brief history. Lastly, what are the advantages of factor-based investing? One is, it is a disciplined process. So as I mentioned, even fundamental investors, or, intuitively, we use most of these factors. When you and me, Shikha, pick a stock, in our minds, we search for stocks that are of high ROE, that are growing very fast, but it is not in a structured manner. When you use factor investing, it's a disciplined approach. Second is, it can reduce risk of your portfolio. Rather, not only reduce risk, it can also enhance the returns in a way, which what it does is, by adding factors, or by adding these kind of styles to your portfolio, you can reduce the overall risk of your portfolio, at the same time increase their returns, and also increase the resilience of your portfolio during tough times, especially years like 2008, COVID crash, and many other such situations. And lastly, you can tailor your solutions. You can, combine these factors, as I mentioned. If you are just invested into simple market cap based index funds, or maybe diversified funds, you can add one or two, a flavor of one or two factors, and change the risk reward, metrics of your portfolio. So these are broadly the advantages of factor based investing. Shikha, if I've missed anything, do chime in and, talk about those points.
Sure. In fact, Niranjan, thanks for that lucid explanation. And while we've heard about the basics and we got a basic understanding of what factors are, I think it's also important now for our viewers and audience to look at how these factors have performed in India. And what we can clearly see here is that, so the one you can see in green here is the momentum factor, then followed by quality, low vol, This we have taken an index to give you a sense on how these factors have performed vis-a-vis the broader market index. Here we've taken BSE 250 large mid cap, which are the top 250 stocks, followed by growth and value. So quite evidently, we can see the spike in momentum, and momentum stands out as a dominant outperformer in the Indian market. Of course, it is followed by quality and then very closely followed by low volatility. Across the periods, data is as on 31st of December. So as you can see, 1-year returns on a 3-year, 5-year and 10-year basis as well. Momentum has been outperforming the other factors. There would be certain, like Niranjan just mentioned, that in the recent past, we've seen finally value has picked up and it has outperformed. And therefore, you can see basis 1 year and 3 year, even value has popped up into the table and is in a dark green color. So which means it has also been performing very well. And so you can see that different factors are ranked differently in India, but very important to see that this is as on a particular date. So therefore, to give an even more clearer picture, it'll be interesting to see how over the years these factors have performed. While we've seen that momentum was a dominant factor and over the recent past, value was also the dominant factor. But as you can see here, every single factor goes through its own cycles. So we can clearly see that momentum had performed very well along with quality in the year 2014. And then again, momentum came back in 2017, and of course in 2021 and 23 as well, it has performed really well. Value has performed well in the last 2 years. So when we saw the as on date returns, we would have thought that probably value is another very dominant factor. But as we can see here, it has seen its own years of underperformance in relative to the other factors. So therefore, the moot point or the important point of this slide is that all factors go through their cycles. And but yeah, having said that, in India, momentum is definitely the ruler in terms of giving factor outperformance. So Niranjan, having seen this, I think it will be interesting to get a little more insight on what is this momentum factor that works so well in India.
Right. So let's deep dive into momentum factor, and I would start with saying this, that momentum factor is the most easiest factor to understand out of all other factors. While other factors are even they are simple, they are not rocket science, but momentum is very easy to understand, and it actually encompasses all other factors into it. So what is momentum? Momentum, as I mentioned earlier, is basically riding on the winning stocks. When I say that, let's take example, a stock is doing well over the last, say, 6 months and 1 year. So out of 10 stocks, there are 1 or 2 stocks that are performing the best amongst these 10 stocks in last 6 months and 1 year. And when they are performing well, there could be multiple reasons to it, right? And there could be one reason that everyone wants to participate in that business because it is growing. When I say it is growing, means fundamentally it is doing well. Maybe their profitability, its profitability is growing. Its sales is growing. Sentiments or maybe some government policies are in favor of this business, which is being done by this company. Multiple reasons. There could be fundamental reasons. There could be technical reason. There could be structural reasons also. Now, momentum, when you talk about momentum investing, it is talking about the price of that stock. It is growing. And as we say, everything is in the price. So momentum is just picking these kind of stocks, which are witnessing a rising price over the last 6 months or a year, and then investing in a bunch of these stocks with the expectation that because they are doing well, it will continue to do well. And that's broadly the basic thesis of factor investing, right? It is, not maybe repeating the past, but, rhyming with the history. What has been going on, it will continue to go on. So momentum investing is all about that. When we look at momentum investing compared to maybe traditional investing, there is a slight difference. In traditional investing, what you say, or what we rather say, is buy low and sell high. In momentum investing, we don't look at whether we are buying at low or what price, but one thing is for sure that we are buying when the stock prices are rising, which is buying high and selling even higher, because the expectation is that this trend will continue and we'll be able to sell higher. And historically, momentum has worked very well, especially in markets like India, where growth is high. The stock market returns are higher compared to any other, even emerging market or developed market. And this trend we have seen, when you pick up a winning stock, at least for some point in time or some period, maybe 1 year or next 2 years, it continues to do well, and you are just riding on those stock prices going up. And hence, historically, if you see, we have compared all factors: momentum, low volatility, quality, growth, and value. Momentum has actually outpaced all other factors, especially in India. The average 5-year rolling returns is around 21%. The next best return is given by quality as a factor, which is 16.5. So an outperformance of almost 5 to 6% over many, many years. Minimum outperformance is also strikingly well. What is important is the excess return band. So almost more than 80% of the time, it has outperformed broader market indices by more than 5%. So 80% of the time, this momentum as a factor has generated more than 5% excess return, is something investors can't miss. So I'm not hard selling this as a strategy, but these are the facts. So momentum actually has worked well. We also need to understand that momentum also comes with a certain cost. Generally, you will see momentum will have a higher standard deviation compared to others, especially low volatility as a factor, maybe quality and value. But on a risk-adjusted basis, what we call it, return per unit of risk. So how much risk you are taking and how much return you are being compensated for taking that risk is important metrics to see. And in that, momentum actually does very well. So here, if you see what we have done, the 5-year return has been around 21%. The standard deviation is around 5% between the returns for this period. And if you just divide this and calculate return per unit of risk, it's around 4.2%, which is significantly higher than most other factors, apart from low volatility, because low volatility generally will have very low standard deviation and returns are in line with markets. So on a risk-adjusted basis, that strategy is actually meant to give you higher risk-adjusted return, and that is what we are seeing. But apart from that, momentum actually outshines on this factor compared to many other factors. So hence, I think so momentum is doing very well as far as India is concerned. And it's also not surprising that in India, if you see the graph which you showed, Shikha, the rise of factor-based investing, a significant portion of that rise is into momentum-based strategies in India.
Okay. Thank you for that, Niranjan. I think some key takeaways for me are also that while momentum is the dominant factor, there would be certain periods where momentum may perform, may not perform. It also gives you relatively higher returns, but that may also come with its own choppiness, its own ups and downs and uncertainty. But that is true for any other factor as well. So we saw that while value at a certain period was giving you returns, but over the years, it may not have yielded you as much or as high returns. So therefore, all factors come with their own set of volatility and cyclicality. So therefore, while if a particular investor is interested in a particular style, like you mentioned earlier in the presentation, so they can pick between or among the various factor styles that are available in the market. But also somebody who wants to be a little more cautious and probably is looking at risk-adjusted or more efficient way of managing, probably combining some of these factors to create more efficient portfolios can be an option for the investor. So if you can spend some time on this aspect as well, will be helpful.
Sure. So now, as I said, in recent last decade or so, we have also seen multi-factor investing becoming more prominent globally, and India also it has started. So what is multi-factor? So while we understood, there are single factors uh, that do well in a particular market conditions, but when you want to win a match, win a test match, maybe you need all kinds of players, right? So that on day one, one player would do well, day two a bowler would win that session for you. Like that, in investing also, if you combine these multi factors, what you get is a good decent outperformance in your portfolio across cycle, which is very important. As we saw, momentum can do well for extended period of times, but there could be 1 year where it is not doing well. Value as a style in India for last maybe decade or so, it didn't work, but last 2 years it did well. So if you were just invested in value as a single factor, it might have hurted you during those period. So multi-factor approach actually takes away that risk. It actually creates a nice synergy. It gives you a better risk adjusted returns with much more diversification. And most importantly, as I mentioned, it adapts to changing market cycles. Some of the multi factors. Now, if you see, maybe we can go to next slide, Shikha. We can, yeah. So if you see low volatility and momentum as a factor, how it has done well. Uh, on a 5 year basis, if you see low vol as a single factor, the return is roughly around 21%. Momentum is around 30%. If you just combine 50-50% into both of these factors, your combined return is roughly around 27% with much lower standard deviation of around 19.43. And risk per return per unit of risk also increases drastically. Now, and if you see on the graph also, the phases where single factors haven't done well, a combined or a multi-factor actually gives you much more smoother ride compared to single factors. Like that, there are a couple of other variations that you can look at. Quality plus momentum also works very well in the long run. If you can see over the last 10 years, quality as a single factor is given 19% return, momentum around 26%, and combined return is around 24%, which is, slightly lower than just momentum factor, but significantly higher than, quality as a single factor. What is important is, again, the risk. The risk has been reduced, and the return per unit of risk has also increased a lot. Uh, and generally, combining momentum with other factors works very well because we have seen cyclicality in some of the factors like, value or even quality for that matter, is much higher than many other factors. And momentum actually helps during those phases when these single factors aren't doing well. In US, because they have a long history, low vol and momentum actually has worked wonders for investors over the last maybe 50 years or 60 years.
Sure. So essentially, Niranjan, if I may summarize, so combination of factors and especially overlaying a single factor with the momentum would work very well in the Indian market environment as well.
Yes.
So that is one key takeaway for us. So while we've up till now we've spoken of the basics of factor investing, how it has performed over multiple years, how different factors have performed over years, and how now combination of factors work. But I think one important point that the investors or the audience is also looking forward to, I'm sure, is how do you invest in these factors? Now, somebody would be keen to look at either quality or to low volatility or momentum. So what are the ways of actually now investing and gaining out of these factor strategies?
Right. So one of the easiest way out there is index funds, because factor-based investing, while it can be done in active as well as passive, but for most investors to start with passive funds would be the right way and the easiest way to invest. In India, we have these factor-based indices mostly by NSE or BSE. and some of the offerings that we have at Edelweiss, we have picked and chosen some of the most consistent single factor or multi-factor indices for our investors. We have launched a midcap momentum factor index. I think, yeah, okay. So this is basically a momentum based factor index, which identifies top 50 momentum stocks in the mid cap space and delivers very good returns compared to a normal market cap based mid cap index. If you see over the last 15 years, this index has given 28.44% returns versus a normal mid cap 150 TRI, that is 21.34. And during the same period, a normal Nifty 50, which is a large cap bias index, would have delivered somewhere around 15-16%. I don't have the exact numbers, but that's how it is. So, when we select a mid cap as a segment to invest, we expect an outperformance over large cap. And when we select momentum within mid cap, there is a significant outperformance over and above this mid cap index. So, while these numbers are quite unbelievable, but over the last 1 year, when we have actually ran this fund on this index, the returns are quite extraordinary, and investors can benefit out of this. Again, when you are investing in a mid cap strategy and especially momentum, your investment horizon has to be longer. You can't invest for a year or two. It has to be minimum 5 years, 7 years, or 10 years. And broadly in this segment, SIP, investing through SIP works really, really well. The other very interesting, factor-based index, this is one of the oldest that we have in India, is Nifty 100 Quality 30 Index, and we have index fund based on this index. Again, as we know, quality is using stocks that are growing consistently in terms of profitability, have very high or relatively higher return on equity, and most importantly, lower debt to equity, which actually helps you or gets you invested into very quality stock. This index, again, since 2009, if you compare, it has outperformed significantly a normal Nifty 100 TRI, and which much more qualitative portfolio compared to a normal market cap based index. And the third addition that we did recently, which is basically a large cap oriented solution, it is called Edelweiss Nifty Alpha Low Volatility 30 Index. What it does is basically it combines both these factors. When we talk about alpha, it is in a way a momentum factor. It does well, when markets are doing well. On the other hand, we have combined this, or this index combines this factor with low vol as a factor, which is a defensive factor, which does well during market downturns, or when market is choppy or much more volatile. So a combination of alpha and low vol actually works very well, and gives you a very consistent return across market cycles, especially in the large cap space. So if you're looking to invest in a large cap space where generating alpha is quite difficult, even for the broader indices, this index has done very well. Over the last 10 years, the index has generated 20% returns versus maybe around 14% by Nifty 100 TRI. So these are broadly three strategies that are based on index, which uses factor. But at the same time, as I mentioned, there are not only passive funds that are available in India today. And we at Edelweiss actually have been practicing factor investing for almost 15 years now in some of our active funds also. And taking that experience, we are also, happy to launch a fund that is Edelweiss Business Cycle Fund, which uses factor investing as a philosophy, as an approach to pick up stocks. And what we are trying to do here is we are using momentum as an overriding factor to select value stocks that are doing well, growth stocks that are doing well, and quality stocks that are doing well, using momentum as an overriding factor along with these three factors. So it's basically a multi-factor based index to identify stocks or businesses or other sectors that are doing well and invest in these sectors, which aligns your portfolio of this fund based on the current business cycle that we are going through. So it's a very interesting strategy. You can, know more about this fund on our website, and it's coming up soon. The NFO starts from 9th of July, and you can definitely look at this fund as well if you're looking to invest in active strategy, which uses factor-based investing as an approach.
Okay, great. Thank you, Niranjan, and thank you to our audience for staying with us till the end of the presentation. And so now is the time for you to ask your questions. So please feel free to post your questions in the Q&A section or in the comment box, and we would be happy to take those questions. So we've received a question, or rather a comment. So wonderful presentation. Thank you for that. Yes, we will be sharing the presentation along with the recording of this call as well by early next week. So yes, the recording of the call as well as the presentation will be with you, so that will be taken care of. So Niranjan, there is another question asking that so Nifty Midcap 150 momentum is something that is the more popular one that is being offered by Edelweiss. So someone who's looking at, say, a large cap alternative or a large mid-cap alternative, what would you recommend, or what would you suggest among the offerings that we have?
Right. So we have a very interesting fund that is Edelweiss Large Mid-Cap 250 Index Fund. We were the first to launch this fund. I think so many other AMCs have also launched this strategy. It's a very good, plain vanilla fund, which very subtly uses a factor, maybe a equal weight factor. What it does is it takes top 100 large cap stocks, assigns it 50% weight, and takes the next 150, that is 150 mid cap stocks, and assign 50% weight. And at any given point in time, there will be a 50% weightage to large cap stocks and mid cap stocks, and it will keep rebalancing every quarter. What happens with this? There are two things. One is, if you are investing in a normal market cap based index, maybe a normal large and mid cap 250 index, your large cap portion is skewed. Almost 70-80% of the exposure goes to large cap because it is market cap based weighted. And mid cap exposure is very limited. Here you get 50% allocation. And as we all know, that size outplays, over the longer period of time. The second thing is it automatically rebalances. So at any given point in time, if mid cap is outperforming large cap and the weight of mid cap skews to maybe 55% and large cap is 45%, it will book profits and reinvest that money into large caps. Same way, when large caps are outperforming mid cap, it will book profits in large cap and reinvest in mid caps when they are maybe undervalued. Actually, that helps a lot in outperforming over a longer period of time. So it's a very simple plain vanilla index. What is important that it assigns equal weight to mid cap and large cap, which where most other indices that are normal market cap based indices struggle, because they will give you that skewness to large cap, and hence it has outperformed over the last 10-year or so. If you see, it has outperformed, and the alpha is roughly around 1.5 to 2% over a normal market cap based index.
Sure. There is a question on the mid cap momentum fund, that whether it is available now for investment or is it yet to be launched. So this fund is already launched and available for either lump sum, or you can even consider SIPs into this particular fund. So we have the mid-cap momentum fund already launched and up and running. So Niranjan, another question, a very interesting one, that momentum stocks have high volatility. So is there a way to enter or take advantage of momentum but with low volatility?
Okay. So, I did mention that we launched this alpha plus low volatility as a strategy. So alpha plus low vol is a strategy which combines, the best of both the world. Alpha is nothing but, capturing price momentum of a stock. So here you get momentum factor, and low volatility actually reduces the risk of that momentum to some extent. And hence, on a risk adjusted basis, if you see, it has done extremely well. So if you are searching for a momentum strategy which is lesser volatile than other momentum, plain vanilla momentum, this is the fund, or this is rather the index that you can look at.
Okay, great. So I'll just take a moment and wait for your questions to come in. So once again, please feel free to post any questions that you may have on passive funds or factor-based strategies into the comment box or Q&A section.
So Shikha, meanwhile, I'm preempting this question that people, often think that momentum as a strategy does well when markets are going up, but it suffers when markets are going down. To some extent, it is true, but it is not true in the long run, because imagine when markets are doing well, when for last 1 year, and there is a bunch of say 10 stocks. Out of that, you have to select 5 stocks. You will select 5 stocks that have done well compared to all other stocks within those 10 stocks, and it will capture the upside. Now, at the same time, imagine next 1 year, markets are down by maybe 10-20%, and these same 10 stocks are falling. Now, what momentum strategy does is momentum actually selects the least fallen stock out of these 10 stocks, the best performing. So the best performing 5 stocks when markets are going down will be the stocks which have fallen least. So momentum actually works in both the market cycles. When market is going up, it will select stocks that are growing faster and it will invest into it. At the same time, when markets are going down, it will invest into stocks that are falling lesser than others. So over a longer period of time, it actually works in both market condition. When it doesn't work is, when the tide changes suddenly, when suddenly market shifts from, consistently going up and there is a drawdown of maybe 20-30%, there is a possibility that stocks that were doing very well may fall more in that 1 month. But once the rebalancing happens, it will again select stocks that are outperforming in that falling market. So give that strategy some little more time, and it actually does wonders in both market conditions. But yes, as you rightly said initially, that there will be more volatility in this, and you need to digest that and stay invested through this period.
Yes, absolutely. And just to add on to that, so this does give you relatively higher returns, the strategy of just being solely invested into momentum. But anyone who would like a more smoother journey, a more efficient journey, and deploying factor-based strategies, you can always combine two different factor indices, and that can probably give you a more efficient returns. So either you combine, say, the momentum index with the quality index, or we have the alpha plus low vol option also available, which integrates two different factor strategies. So Niranjan, a very interesting question. So is it possible to find stocks which have all the parameters: momentum, value, quality, growth, low volatility?
A rare possibility, but it may happen that one stock comes up in not all at least, but 1 or 3 factors. Like there could be a value stock which is doing well, so it comes in value also, it comes under momentum also. Low vol I doubt, but it may come under value, maybe quality or growth and momentum also. And that's the reason, when I said that historically in US, a combination of low vol and momentum has worked very well, because usually they have inverse correlation. Low correlation, not inverse, very low correlation with each other. And rarely you will find a stock that is low on volatility, but very high on momentum. Rarely you will find some, maybe, in COVID period, healthcare stocks did quite well. Now, these stocks are known to be low volatile, and they were doing well. So in momentum index, you will find healthcare finding space during COVID period, when there was the recovery. So there could be some rare periods where these two factors also come together. But yes, overall, we may definitely experience where a stock comes up in two or three more or even more factors, and it gets picked up. And that's where, that's how multi-factor strategy actually work. uh, a higher weightage to a stock may come up if it is showing signs of being or showing higher scores or scoring higher on most of these factors.
Sure, sure. So, Niranjan, someone who's starting off their journey into passive funds or into factor investing strategies, what would you suggest on how should they start that off? And as they gradually get used to this investment experience, how can they then mature and graduate to the next set of strategies?
So I always use this core and satellite as an approach. Your core has to be your market cap based indices, because they exist for more than 200, 300 years, and they also do well. In a way, market cap is also a factor which has a proven track record. And so your core has to be maybe factor based indices, market cap based indices, and a satellite, maybe a 10-20% exposure. You can start having basis what objective you want to achieve. So if you want to reduce risk in your portfolio, you are risk averse investors, maybe low volatility is a factor based index that you can or a strategy that you can add. If you want to enhance your return, maybe a growth or a momentum as a strategy can be added. And if you're not sure that which factor I want, then maybe a multi-factor, maybe alpha plus low vol is a good addition to your satellite strategy. And gradually you can move, especially momentum. If you are investing in, then be sure that you are investing for a longer period of time because it's an aggressive strategy. And in the short term, be ready that there could be drawdowns as well. But eventually they bounce back very fast. So simple, your core strategy has to be market cap based. If you want to reduce risk in your portfolio, add low volatility as a factor. If you want to enhance return, maybe momentum as a strategy. If you're not sure, add both. Maybe alpha plus low vol is the answer.
Okay, great, great. So we can see there's a lot of interest in the momentum fund. So I'm going to combine some questions and ask. So you may enter a stock, you may in the momentum strategy, and to ride the uptrend. But how do you take a call to exit a particular stock?
See, in factor-based investing, there is no bias. There are no emotions. It is also called emotionless investing, right? It is all based on numbers. So when you pick a stock or when a stock gets picked in a momentum strategy, the expectation is if it has done well in last 6 months and 1 year, it will continue doing well. Now, on the next rebalancing, so generally in index, these most indices gets rebalanced on a 6 monthly basis. So over the next 6 months, if the same stock is underperforming, it gets out of the index, and the stock that is outperforming or performing better than this stock gets into the index. So the churn is very, very fast. It is based on pure numbers. And if any stock that is underperforming gets out immediately after or on the day of rebalancing. So it is as simple as that.
Okay, great. So probably we can take one or two more questions. So in case anyone has any question, feel free to post that into the Q&A section or the comment box. So Niranjan, you did mention that there are active strategies also which deploy a factor-based investing approach. And there is one that we would be launching soon in the month of July. And also that Edelweiss has some experience into factor-based investing already. So could you just shed some more light on what exactly are you referring to when you say that we have a certain expertise in this particular area?
So at Edelweiss, a couple of our strategies, especially in the hybrid space, and large cap space have been run using factor-based investing. for more than decades now. And when I talk about factor-based investing in active strategy, what it does is basically, uh, to simply put it, it is basically a rule-based investing using specific factors. So we have a separate team at Edelweiss, you know, headed by Bharat Lahoti and Bhavesh Jain. Uh, so this bunch of team members, what they do is they have a very well researched library of factors that have done well and have proven track record in India. When I talk about these factors, these are same factors like growth, value, momentum, quality, low volatility. And what they do is they mix these factors, and basis the objective of the fund, they combine these factors and simply put out these rule and create portfolios. Uh, in active, as I mentioned, it is emotional less investing. Same goes true when it is followed in all these funds. They look at the stocks in a very objective way. They put filters, pick up stocks using these factors. So if it is a growth plus quality portfolio, they will look at stocks that are doing well based on growth factor, based on quality factors, and then combine and create a portfolio. And over the years, we have seen that our large cap fund, which have just completed 15 years, it has amongst a very few funds which have consistently generated alpha over the Nifty 50 strategy. We use factor-based models to solve asset allocation issues in our balanced advantage fund, uh, which has a proven track record, which is amongst the largest balanced advantage funds out there. Has been running or solving asset allocation issues uh, for this strategy over the last decade or so. It has done extremely well within the peer set and versus benchmark. Our aggressive hybrid is being run on this strategy for almost more than 5 years now. So that's where our expertise lies when it comes to factor based investing in active. And using that expertise, we are launching a business cycle fund where we are trying to solve a problem of sector timing. So that's broadly what we are trying to do.
Okay, that's great. So there's a question. The business cycle fund, is it the first active factor-based fund in India?
It is not, because there is a category called quant, and there are multiple funds out there in that category. But I would definitely say it is quite unique. Using momentum, quality, and other factor, and overlaying momentum factor over this. Probably this could be one of its kind of strategy. But one of the oldest fund, I'm just guessing, maybe a large cap fund would be one of the oldest fund, which is following factor-based investing approach. It's been 15 years. So maybe 15 years back, there was hardly any fund that was predominantly using quant or maybe a factor-based investing approach. So probably that would be one of the oldest funds.
Okay, sure. Also, in the passive strategies that we run, or for that matter, that any other fund house would run, is there any call that the fund manager takes, or that is the essential difference between the active strategy and the passive strategy?
Right. So good question, Shikha. In passive, the role of fund manager is just to replicate the index. There is no call. If at all they take any call, it leads to tracking error and tracking difference, which is not allowed as per any standards in passive funds. In active fund, yes, definitely, because it's an active strategy, there could be some active calls or some interjection in the investment strategy, but that again is at a very minimal level. Uh, you know, just to give you an example, like the churn or the calculation of factor-based portfolio happens maybe every 2 months or 3 months, but in between there is a news on a particular stock. Fund manager are more than willing to exit those stocks or even buy those stocks, whatever is the case, and take that active call in these funds. But broadly, while constructing the portfolio, the philosophy, the heart and soul of the fund strategy is to follow this factor-based approach, use models to select stocks and stick to that. So I would say 95 to 99% of the time they stick to the model. What is more actively done, especially at our factor-based investing team level, is researching more about what factors are driving stock prices, what factors are working in India. And the model that I talked about, the model of combining these factors, you know, gets evolved over a period of time. And that is the active call which a factor-based investing team actually does and should be doing. And our team has been doing that. So if you see last 15 years, if you ask me, Shikha, whether the model has been same, the answer is no, it has not been same. It has evolved. And that's broadly the expertise of factor-based investing is all about. You keep evolving your model as per the market conditions because different models work in different economic conditions, different countries, different market cycles.
Sure. Thank you, Niranjan, for putting it out so, making it so simple for all of us to understand the key differentiation between passive and active factor and strategies. So I'll just take probably one last question and then I may ask you to please summarize. So do we have an equal weight factor-based fund?
Yes, in market, I think so. There are equal weight indices like Nifty 50, Nifty 100 indices are there, and there are index funds out there. And people can look at those indices. What we have is a large and mid 250 index fund that I spoke about. It essentially assigns equal weight to large cap and mid cap stocks, but within that the stock weighing is not done equal weighted. The allocation to market cap is equal, but within that it is based on free float market cap of the stock. So in a way, it is maybe a partially equal weighted strategy to ensure that your amount is spread equally between large cap and mid cap to generate alpha.
Sure. Thank you. So before we wrap up, Niranjan, any quick takeaways for our audience? The main point that I think and that I'd like to just highlight is that there are different ways or different approaches to creating your portfolio of stocks. And while you may want to you go bottom up and pick individual stocks, factor-based, essentially it groups your stocks into specific styles that we spoke of, either value, growth, or momentum. So depending on what a particular investor is looking at, these bunches are available and we can go ahead and invest in those specific buckets. Anything that you would like to add on, Niranjan?
The only thing is, factor-based investing, especially in India, is picking up. I would sum it up as it is one of the most disciplined way of picking stock and investing, and it has its own space, or rather it warrants some exposure in each and every portfolio, whether it is into passive or active. But factor-based investing has its own place in all the portfolios. People should start exposing or taking some exposure into these strategies is what I would say.
Okay, great. So thank you, Niranjan, and thank you everyone for your enthusiastic participation in this call. For any further questions, please feel free to write to our customer service desk. We'll be happy to address all your questions. And also, I'd like to add, for any further information, I would highly recommend there is a video that we have released under our Market Talk series, which is available on YouTube. A good 25-minute about session by our co-head of factor investing, Bharat Lahoti, who explains in very, very simple language what factor investing is. So yeah, I think a great primer for to further understand what factor investing is. So yeah, once again, thank you everyone for joining in, and we look forward to seeing you in our next session.
Thanks.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.